Alrighty, welcome to the daily. Go ahead and do here is I'm going to go ahead and make sure that I share my screen properly this time. We're going to go ahead and hop into TradingView, and from TradingView, I want to go ahead and run through some of the most important charts of the day. So join me and let's take a look at this stuff. Let's go ahead and start off here with Bitcoin, BTC. And, look, this is a monthly. And on the monthly, sometimes I think it's valuable to zoom out. On the monthly, we've got a really big wick forming up here. So I know today is only the 21st, and we've still got, another week and a couple of days until the end of January. But as of right now, this big wick, it looks to me like Bitcoin wants to push a little bit lower here. Now let's zoom in from the monthly to the weekly. And Bitcoin has found a level of support. Now, I had to redraw this level of support because it broke yesterday, and then Bitcoin was able to reclaim it earlier today. But on the weekly, this big red candle still holding support, it tells me that, hey, you know what? If I go ahead and clone this and draw this in, Bitcoin still looks like it's just forming this flag here, this bear flag. And it looks like if it really breaks down with some momentum to the downside, it probably doesn't stop at 80. I think it goes to 75. Now let's zoom in even further to a daily. On the daily, it's pretty clear that Bitcoin has found a level it likes as some support. But if this breaks, then I think it's just a matter of time until Bitcoin either touches 80 or touches 75. So Bitcoin looks like it really needs to hold support. But here's the thing though, whenever I hear someone say this time it's different, and this time, the market cycle analysis is going to break, it's not going to hold, this is going to be, just another bull year for Bitcoin, when the cycle analysis has been correct. Even if you don't agree with it, it's been correct, it's been prescient. So I'm just thinking to myself that maybe this time it won't be different. And maybe this time Bitcoin will move to the downside and have another, another leg lower. But maybe the bear market trough this cycle is shallower than the troughs in previous Bitcoin bear markets. So maybe we see Bitcoin down by only 55% or so this bear market. Let's take a look at ETH. Here's ETH. So Ethereum's got this level of resistance above at 3,400 and this level of support down below, which comes in right now at right around 2,900. So Ethereum is, again, just chopping around in this range here. And if this level of resistance breaks to the upside, then we could start talking about 36 or maybe 4,200. If this level of support really breaks with some momentum to the downside, then we're going to be talking about 2,600. And if that breaks, we're going to be talking about 2,100. So that level of support all the way down there at 2,100 for ETH, that looks like a decent target, in my opinion, for a short trade. Something like that over the next couple of months seems to make sense to me. Let's go ahead and move on over to Solana. So Solana, I mean, look, this looks like a range to me. And it did not break out above that high that it put in back in the middle of December. So this relief rally failed after just barely eclipsing that high from the beginning of December. And that is a big move lower and sharp too. So I think a long entry on Sol might make sense right around 117, just to, trade a small bounce off of support. Now, if you want to trade that, I would recommend setting a very tight stop. It would be something like right or right out, where you're either right on direction or you're right out of the trade. So you could set a stop. If you enter at 117, you could set the stop at like 115, 115 half, something like that. So that at least if you're wrong on direction, you don't get wrecked. Okay. So Solana here looks like it's got a little bit more downside ahead of it. Okie dokie. Let's start to take a look at maybe gold and silver, because we did see some pretty big moves out of both gold and silver. Now, gold was able to push all the way up to, it looks like the top of this candle wick came in at 48.9110, just 110 points below that big round psychologically important number of $5,000. So $5,000 for gold, I mean, hey, it would be poetic that gold reverses below 5K and never makes it up to 5K, at least not for a couple more months. That would be kind of interesting. Now, why wouldn't gold rip higher? Well, I think a good reason to think that gold might not be able to continue ripping is if we take a look at the dollar, DXY. So the dollar, if we see the dollar really bounce and push higher, let me throw a 200 day on here. If we see the dollar actually hold on to its 200-day moving average and bounce above 99.5, I think that might generate a little bit of weakness in commodities and in digital assets, but you would need more momentum to the upside out of the dollar for those commodities to sell off a little bit. Now, why in the world would the dollar rally? Well, I think a pretty good reason for the dollar to rally would be bonds and notes selling off. So this is ZB. This is a 30-year bond futures contract. And there are a couple levels that I want to just point out here. Well, number one, let's just zoom out. Let's zoom out to a weekly. That's the first thing. So on the weekly, once we've got, a couple decades of data, this is a big, downtrend here. This is a multi-year downtrend. And what that means is yields have been in a multi-year uptrend. So it would make sense to me that we might see a move down to this level of support. Let me go ahead and zoom in here a little bit so we can see this more clearly. All right, so right here, this level of support, what is that? That is a move all the way down. That's another 4% almost to the downside. And so what could that do for long end yields? Well, if we take a look at the US 30-year yield, we've got an interesting pattern shaking up here. So take a look at this gap. Big gap that formed over the weekend, I believe. And it looks like that is probably going to fill, or at least try to fill. But if yields keep pushing up towards 5%, that could be a reason for the dollar to move a little bit higher. That when you see yields push higher, usually you'll see the dollar rally also. But we haven't really seen much of that, even as yields have pushed higher over the last, maybe a couple of months here. Even as yields have pushed higher, the dollar has just been treading water. So it makes me think that even if yields continue to push a little bit higher, if they don't move sharply higher, the dollar might actually break support. So let's zoom out on the dollar and let's see, where could it go if it breaks support? Well, take a look at this. This is long-term trend line support here. Long-term trend line support. If the dollar breaks down below that long-term trend line support, probably has 9% or so to the downside until it finds its next level of support at around 90. Man, I think that would probably be pretty bullish for commodities. Now, what would that mean for equities if the dollar sells off? Well, it really depends. And let me just go ahead and remove these drawn objects here. I was just in the last session describing Pendle PTs and YTs and those SY wrappers. Okay, now that I've got that removed, I just want to go ahead and snap this into frame here. So S&P, these are S&P futures. Now, take a look at this very clearly defined channel that S&P futures have been in for the last, 5 years or so, anchored to the COVID crash lows. So this is a pretty well-defined channel. And where are we now? are at the very top of the channel. So it would make sense to me that maybe the S&P has a little bit of downside ahead of it. Let's zoom in. So on a daily, we've got this gap that opened up and didn't quite fill today. Got very, very close. If we zoom in a little bit further, you'll be able to see that that gap was very, very close to filling, but it didn't quite fill right there. So if I just grab that brush tool and highlight this, they call this, traders call this a CME gap. That's the CME futures gap, because this contract is traded on the Chicago Mercantile Exchange. And over the weekend, the Sunday open price opened lower than the close on Friday afternoon. So it creates what's referred to as a gap. Now, gaps tend to fill, but if you get a gap fill and a reversal after the gap fill, well, then maybe, since we know that the S&P is actually near very, very close to trendline resistance here, if we get that gap fill and it reverses, that would make sense. Maybe we have a couple of weeks on the downside. Why don't we take a look next at volatility? Because if we're going to get downside out of the S&P, which, taking a look here at volatility on the weekly looks less likely. In fact, it looks as though that little bit of volatility that we had over the last 2 days, it looks like that might actually be it for vol for a little while, because volatility is a mean reverting asset class. And whenever you get pumps, it tends to revert to some type of mean. So a mean is simply an average. So, for volatility futures, I kind of think here that this level of support that I've drawn in, that could be an interesting level for volatility to mean revert to in the immediate term. And also notice this is a gap, but this is a gap from a futures roll. So right here, that is a futures roll. And you can see they call it a contract switch over here on TradingView. If I go ahead and grab that tool, you can see it. They call it a contract switch. I call it a roll. You're rolling from the front month to the next month, the next front month, when that current front month expires. So this gap could fill. And if it does, that would mean volatility mean reverts all the way down to maybe 17 or maybe even below 17. So if volatility is moving lower, that likely means that equities markets are pushing higher. So we might actually see not just the gap fill out of the S&P, but we could see that gap fill and the S&P push back up to resistance up here at maybe 70.50. So that would be another 125 points to the upside. That could happen, especially if vol just gets smashed. So one equity market index that has already filled the gap is the Russell. So the Russell 2000, not only did it already fill the gap, but it's actually pushed to fresh all-time highs here. So these are interest rate sensitive stocks. So if the Russell is ripping to fresh all-time highs, that kind of tells me that we should be, expecting yields to pull back. But I just don't see that when I take a look at the 10-year. So this is, 10-year yields. It looks like yields in the 10-year could be headed up towards maybe 4.6%. That seems to be a level of resistance. So if yields actually push higher, then maybe getting long Russell items is premature. That could very well be the case here. So we've taken a look at Bitcoin, Ethereum, Solana. We took a look at 10-year yields, bonds, notes, the dollar. We took a look at the S&P, the NASDAQ, the Russell, volatility futures. Let's take a look. We looked at gold and silver. Let's see here. What else do we want to take a look at? How about a measure of bond market volatility? So this has been really interesting. And this is probably one of the best indicators of, real stock market volatility. And so here's the reason why. This index, this MOVE index, this is a measure of bond market volatility. It has been very inversely correlated with the S&P 500. So let me go ahead and invert the scale. So now that I've inverted the scale, the next thing that I want to do is I want to throw the S&P futures on top of this. Look at how tightly inversely correlated these two are. So now that we're seeing bond market volatility start to mean revert and push back to the downside. Remember, this is that bond market vol pushing lower. This is the S&P 500 inversely correlated pushing higher. So when we see bond market vol pushing lower, and then we see the S&P rebounding, it looks like we might actually have more room to the upside out of the S&P. And I think that really does tend to make sense to me, just because whenever there has been geopolitical problems, whenever there have been tariff tantrums, that's always turned out to be a buying opportunity. So the most recent geopolitical issue around Greenland, around tariffs on European countries from the United States, that seems to be resolving itself, and markets are pushing higher on the back of that resolution. So if we're not going to see further downside out of the S&P, well then could it be an interesting entry to get long Bitcoin? Could it actually make sense? If I go ahead and zoom, let me go ahead and see if I can bring that scale. There we go. So could it actually make sense to get long Bitcoin at this level of support? If we're going to see equities start to push back to their all-time highs, we already have the Russell at fresh all-time highs. If we're going to see yields maybe pull back a little bit, if we're going to see the dollar maybe start to move back to the downside a little bit, maybe this is actually an interesting long setup, because you could say that Bitcoin is just trading within this, this kind of channel here. And so if Bitcoin is trading within a channel and it's at the bottom of the channel, that's kind of where you want to buy it. You want to get long at the bottom of the channel and get short at the top of the channel. So that actually might not be a bad trade. Look, here's the thing. If you believe that Bitcoin throughout the rest of this year, if you think that we've entered a bear market for BTC, but if you're wrong on timing the entry of your short, there's no difference between being early and being wrong. So if you get short here and Bitcoin bounces, and it bounces by, maybe something like 10% or 11 or 12% up to resistance, and you're levered short and you use 10x leverage, you go to zero. You would lose your entire margin if you're levered 10x short and Bitcoin bounces by just under 10%, would get you liquidated. So maybe the short opportunity is just a little bit premature in BTC. Now let's start to flip over the cards here. Let's say that maybe that Bitcoin halving analysis is actually going to be broken this year, that the halving cycle, the Bitcoin cycle analysis, that's going to break this year. If it's going to break, how would you know that? Well, if Bitcoin is able to get above not just 97.7, but also break above this level of resistance and get back above 107 up here. So if Bitcoin can not just reclaim 98, let's call it, but also get back above 108. So if we can get above 108, I'll just go ahead and remove that. If Bitcoin gets back above 108, probably heads towards those old all-time highs at 126. And that would kind of sort of resemble what we saw last cycle, where we got that move back up towards the highs that were put in April and ended up putting in a higher high. But when I look at this pattern here, this really looks like a bear flag to me. So even if Bitcoin does make it back up to 99 or 100K, man, I still think that it's probably a better bet to be short at 100K than to be long at 100K. So that's what I see on BTC. Now, one trade that I have had my eyes on and that I'm just waiting for the entry is USD JPY. Now, the reason why I'm so interested in trading USD JPY is because of what's going on in Japanese government bonds. So I put together a ton of research in the DeFi University school community on the crisis that the Bank of Japan is facing, and they've got a trilemma right now. They can either save the bond market, or save their banking sector, or save the yen, but they can only save 2 out of 3. They can't save all 3. And so I'm of the opinion that they're going to choose the bond market and the banks and allow the yen to continue to inflate and use the yen almost like an escape valve. And so if we just zoom out here on this chart of USD JPY, look at this. So if we just zoom out and take a look at this, this level of resistance from and this is a monthly chart. So this level of resistance this was back in April of 1990. That level of resistance at 162. Notice where the yen found resistance back in 2024, in June 2024, found resistance again at 162. So the trade idea here is to get short the yen, but wait for an entry above 162, because if the yen gets above 162, man, there really doesn't seem to be much serious resistance until maybe 200, that big psychologically important number around 200. So when I take a look at this, I think, okay, well, all I've got to do is be patient and wait for that entry above 162 and then ride it with a tight stop up to 200. That's what I'm thinking about. But I don't necessarily want to trade the yen I don't want to be long dollars if I'm going to be short yen. I would much rather be long something like the franc. So something like CHF. So if I type in CHF JPY, there we go, CHF JPY, this is what I would prefer to trade. So this is a monthly chart, number one. So let's go ahead and zoom into a weekly. And what this is showing us is the outperformance of the franc in yen terms. So if I am at long USD JPY, let me just go ahead and write out the trade here. So if I'm long USD JPY like that, then I am long dollars, short yen. But I don't want to be long dollars. So what I can do is if I find something like CHF USD, then I would be long the franc, short the dollar. So long the franc, short the dollar. These cancel out. And what I'm left with is long the franc and short the yen. And that is what this shows. So this is what I'm looking forward to entering, but I just need to be patient for that entry. And so the reason why I need to structure a synthetic like this is because I want to trade this from my DeFi wallet. And the protocol that I plan to trade this on is actually called Ostium Labs. So this looks pretty interesting to me. Now, another thing that you could think about is you might be interested in trading commodities in yen terms rather than in US dollar terms. And so what that would look like is, maybe you want to get long, I don't know, how about getting long silver? But instead of getting long silver in US dollar terms, you could use Ostium Labs to get long silver in yen terms. And this is what that would look like. You would, number one, enter the first leg of the trade, which is XAG USD. So this is silver. You're long silver, short dollars. And then the next thing that you would want to do is get long USD JPY. And so there you're long dollars, short yen. Again, this cancels out. And what you're left with is XAG JPY. And so this is getting long silver in yen terms. And so let's take a look at that chart real quick. So if I go, something like, we can use silver futures, SI1 divided by JPY USD. And this is what that chart looks like. Okay. So here's the problem. The problem is it's so difficult to buy something like this. Like, how do you buy a straight up parabolic vertical move? Like, it's very, very, very difficult to do that. So I'm not sure that I really want to be long silver or gold, after seeing a move like this. But if you price silver in USM2 like so, what you're left with is an inflation adjusted reading on silver. So let's just take a look at this real quick, because once you adjust for inflation, all of a sudden it kind of looks like silver might have more room to run on the upside, because this, if I just go ahead and mark this, this is the 2011 high, inflation adjusted high for silver. And silver has not even reclaimed that 2011 inflation adjusted high. The interesting thing about this is gold has. Gold has reclaimed its 2011 inflation adjusted high, and gold has actually moved above its 2011 inflation adjusted high. So if I take a look at this, here's that inflation adjusted high from 2011. Gold is now trading well above that. So it makes me think that if we take a look at the gold and silver ratio, like so, just like this, we take a look at this ratio, maybe silver gets to 30 at 30 ounces of silver for every ounce of gold. That could be in the cards here. So even though silver and gold have run to the moon parabolically, even though that has already happened, there still might be more room for them to run even higher. So I'm going to be watching that very, very closely. And for the trade that I plan to enter, I'm just waiting for the yen to break above 162. I think that structurally, the yen is most likely to continue weakening. So that's what I'm waiting for. And, I also like a trade on copper. I think that a breakout here above $6.12 on copper, I think that if that breaks out, that would be also an interesting long idea. So I really want to get short the yen. I really want to get long copper. How do you combine those two? Well, you could get long copper in yen terms, long copper, short yen. That would be an interesting trade. And that's probably what we will talk about tomorrow during our next call. Thanks so much for anyone who joined live, and I appreciate you guys. I will see everyone tomorrow.